Very good morning to all of you. Now, so in the last class, we were discussing about the consolidation and business combination on the date of acquisition and on subsequent reporting dates also, right? We discussed what is the meaning of purchase consideration, how to value the investments in SFS and how to value that in CFS, right? Now, there are also we discussed certain adjustments around investments, the around valuation like amount payable to the employees, replacement awards, right, pre-existing relationships like payable or receivable that were there prior to date of acquisition or reacquired rights for that matter. Also for provision for legal damages, we studied those points. Further, we studied about valuation of NCI that can be happen at proportionate share or fair value on the date of acquisition. Subsequently, it will be the same. That is, we have to add the post-acquisition share of profits of or for OCI. But yes, the treatment of goodwill impairment loss was different. Why? Because when the NCI is to be measured at fair value, it's a full goodwill. That is the goodwill for parent and NCI both. But when the NCI is at proportionate share, the NCI is only for parent. So hence, whenever there is an impairment loss, when NCI is at fair value, the goodwill impairment loss has to be applicable to both. Okay, but whenever there is an impairment loss, when NCI is at proportionate share, that has to be allocated only to parent. Okay, so that's what about NCI. Then we studied about valuation of net assets. We understood that the net assets of the subsidiary is to be acquired at fair value, but there were certain exceptions. Okay, the exceptions might be from a fair value concept, or exceptions might be from a particular standard point of view also, right? Like, let's for example, research costs. As per India 38, we have to transfer that to P&L, but here we have to record that at fair value. The next example can be self-generated assets which didn't satisfy the recognition principle, but in business combination they are satisfying the recognition principle, and hence we are required to recognize that, right? The again exception can be from a contingent liability perspective, though we are required to disclose that in SFS, but in CFS we will recognize a provision on contingent liability. So like this we discussed multiple points and for regarding net assets. Now, whenever we are doing the fair valuation of the net assets on the date of acquisition, it will have a consequential impact as well, right? So we studied that as well. Now, further we studied how to calculate goodwill or gain on bargain purchase. Now, for calculation of goodwill, we discussed we have to add the purchase consideration on the date of acquisition, NCI on the date of acquisition, minus the fair value of the identifiable net assets on the date of acquisition. If the value is positive, it is goodwill. If this value is negative, it is gain on bargain purchase. But whenever a question on gain on bargain, whenever a point of gain and bargain purchase comes, we discuss that we have to reassess all the fair values that we have taken, so that it is proper or not. If it is proper, then we have to transfer it to OCI, and then from there we have to transfer it to right now other components of equity basically. Now further, if it is not found to be proper, then what we have to do is we have to directly transfer it to other components of equity. Now further, subsequent to that, we also studied what are the when we prepare the balance sheet on the console balance sheet on the subsequent reporting dates, what should be the treatment for that? Basically, we might have to adjust the unrealized profit of gain or loss with the treatment of dividend, the treatment of bonus, the treatment of time adjustment, that is when we acquire subsidiary during the mid of the year, right? How exactly we have to do the dividend treatment in that cases. So we studied all those points as well. Right, now today, after studying all those generic points, we are studying few specific cases, and the specific cases which we have to study today includes we will study first thing is reverse acquisition. Okay, then we will study common control transactions, then we will study chain holding. Okay, and also we are also required to study some theoretical concepts. Okay, now to start with, first is reverse acquisition. Now what is the meaning of reverse acquisition? See, so far we studied that a parent or an acquirer company acquires a acquiring company. But what happens when an acquirer company acquires an acquiring company? This this is what we studied so far, right? But what happens in the process of acquiring this company? Many times what happens, this company itself gets sold. Okay, so that's case where we say it is a reverse acquisition. Now two question comes up now here. First, how will we identify in the exam that it is a case of a reverse acquisition? Okay, second question, if it is identified to be a reverse acquisition, then how will be the accounting treatment for that? Okay, now comes how will we identify. First and foremost point, it will be specified in the question. Okay, it will be specified in the question. If at all it is not specified in the question, then there will be hint given in the question that a small company has acquired a large company. Let me give an example. Let's suppose a small company like Big Basket. Just a small company like Big Basket wants to acquire Tata. Right? Now, ideally, Tata has acquired Big Basket, right? But now, let us take other way around. A small company like Big Basket wants to acquire Tata. So what will happen? It has to issue all the shares of Tata, right? Because to acquire the shares of Tata, or controlling stake of Tata, it has to give all its shares, right? Basically, the Big Basket will get sold to acquire Tata, right? So now what happens? That's what it says. Whenever a small company acquires a large entity, that's again a hint. That's again a hint that though legally that small company, the Big Basket, is acquiring Tata, but when we assess on a real-time basis, when we assess on a real ground issues, we will find that in the verge to acquire Tata, Big Basket itself got sold. Okay, so that's called a case of reverse acquisition. That's called a case of reverse acquisition. Now, first hint is this one. The question will specify clearly that it is a case of reverse acquisition. Second case is the small entity is acquiring a large entity. The third hint, even if this was not given, then what we will do? We'll see that what is the total number of shares of the combined entity. What is total number of shares of the combined entity? See, legal acquirer is having how many shares? Legal acquirer is having how many shares? Okay. Now, after that, we'll assess the percentage. The entity holding the larger percentage is the accounting acquirer. See, though understand, in this case, in this case, Big Basket is the legal acquirer. Big Basket is a legal acquirer. And Tata is a legal acquiree. But what happens? We have to see from an accounting perspective who is the acquirer. So that's what we will see, that though legally these persons are the acquirer and acquiree and they are holding this many shares, but in substance, who is the actual acquirer? So that's what we say, this person, the entity holding larger percentage, will be called as accounting acquirer. Okay. Now let's take up an example on this one. What happens? Let's suppose A Limited, having total number of 100 shares, wants to acquire 100% of B Limited. Total number of shares is 50 shares. Okay. Now, so what happens? See, this is A and this is B. Total number of shares is 100 and total number of shares is 50. Okay. Now what does it say? To acquire, A Limited acquires B Limited. Okay. Now to acquire, see here. The shares in exchange of one share acquired of B Limited. Basically, it says to acquire B Limited, A Limited issues 3 shares of A for every share acquired of B. Okay, so how many shares acquired? 50. So how many shares issued? 150. So originally we had 100 shares. Additionally, we issued 150 shares. So what is the total number of shares? 250 shares is the total number of shares. Now, out of this 250, how many shares is held by A? 100. How many shares is held by B? 150. Now, can you please calculate the percentage of the shares held by A? 100 by 250? 40%, and B? 60%. So now understand, though in the legal form, A is the acquirer. But what happens? See, the controlling stake is with B, right? So B becomes the accounting acquirer. Is that clear, everyone? So understand what happens here in the case of reverse acquisition. What happens in the case of reverse acquisition here is, though in the legal form a company is acquiring another company, but in the verge to acquire that company, the acquirer company itself gets sold. And this process is called as reverse acquisition. In the exam, we have to identify how it is the case of reverse acquisition is. First, the question will clearly specify it. or the question will state a line that a small company is acquiring a large company, or the third case is this way. You have to see what is total number of shares of the combined entity, or what is the number of shares held by the legal acquirer, and the legal acquirer, the entity holding the large number of shares will be called as accounting acquirer. Is that clear as of now? Now, so far we have answered only one question, that is how will we identify is this a case of reverse acquisition or not. But now once we have identified that this is a case of reverse acquisition, how will be the what will be the accounting treatment for that? Now tell me, what is the process of consolidation? We take the carrying amount of P, carrying amount of net assets of P, plus we take the fair value of net assets of subsidiary, right? Now tell me, let's suppose here in this case Tata and Big Basket, our example, right? Who is P and who is S? Okay, again I'm saying see this one, see this example, and now I try to answer. A was a legal acquirer, B was the legal acquiree. Okay, I'm again writing it off here. A is a legal acquirer and B is a legal acquiree. Now, as per accounting terms, B is the legal, sorry, accounting acquirer. Accounting acquirer as per accounting terms. Okay, that's what we see, because we had large number of shares. Okay, now accounting or console process says us to do this one, that carrying amount of P plus fair value of subsidiary, right, on the date of acquisition. This will be done on the date of acquisition. Now tell me, who is P and who is S? P is B. So what we'll take, we will take carrying amount of B plus fair value of A on date of acquisition. Is that clear now? But you should not say that, sir, A has acquired, right? A is acquired. No. So rather than taking the fair value of B, we'll take fair value of A. Is that clear, everyone? Can we solve a question on this now? Let's try to solve it. So this is the question. Now also the standard says that purchase consideration, the purchase consideration will be the fair value of the accounting acquirer. Sorry, fair value of the accounting acquiring company, the business which got acquired. So right here, the business which got acquired, fair value of the business which got acquired, okay, will be called as a purchase consideration. The number of shares to be issued will be the purchase consideration divided by the fair value per share of accounting acquirer. Okay, now let's start solving this question. Is a question on reverse acquisition. So it says X Limited and Y Limited amalgamated on and from 1st April 2017. A new company XY Limited with the shares of 10 each was formed to take over the business of the existing companies. Okay, see, so far there is no case of reverse acquisition. It says there was a X, there was a Y, they got combined and formed XY. Okay, now this is the balance sheet given. Okay, now further it says X Limited issued a requisite number of shares to discharge the claims of the equity holders of the transferor companies. Okay, also the new debentures were issued in exchange of the old shares series of the both the companies. Prepare a note showing purchase consideration and discharge thereof and draft the balance sheet of X Limited. Assuming Y Limited is a larger entity and their management will take the control of the entity XY Limited. Now what does it say? See, it says X and Y amalgamated, but it says Y is a larger company. So what does it trying to denote? So it says it is trying to denote that Y is an acquirer and this is a case of reverse acquisition, right? So now what will we do in this case? So first and foremost point number 1, calculate the purchase consideration. What is the purchase consideration? Fair value of, tell me, fair value of acquiring company, that is the business being acquired, fair value of acquiring. Who is acquiring in this case? Acquiring is X Limited, because Y Limited is acquirer now, right? X Limited. Now just see, fair value of the business of X Limited is given how much? 11,000, right? So the purchase consideration how much? 11,000. Now we also are required to calculate the number of shares to be issued. And now how will we calculate that? Purchase consideration divided by fair value per share of which X Limited, right? Now what is the purchase consideration? 11,000 divided by what is the fair value per share. So for that you have to see what is the fair value of the business, that is 14,000, divided by what is the number of shares of X Limited, sorry Y Limited, number of shares of Y Limited, 7,000 divided by 10, 700, right? Divided by 700. So it is 11,000 is the purchase consideration which has to be settled for the shares of Y Limited, the fair value of which is 20 per share. Okay, you can write here rupees 20 per share. So the number of shares to be issued is 550 shares. Clear everyone? Now this is the number of shares to be issued. Now third thing that we have to calculate is goodwill. Goodwill. Goodwill is the purchase consideration how much? 11,000, right? Minus what is the identifiable net assets? No NCI in this case, right? Identifiable net assets. Net assets of what? Which company? X or Y? X Limited. Now let's take the net assets of X Limited is how much? 6,000 plus 3050 is the carrying amount. 6,000 plus 3050 plus if there is any fair value adjustment we have to do that also. Now just see the fair value is given of property plant equipment is 9,500. What is the carrying amount of property plant equipment? Property plant and equipment carrying amount is 8,500. So what is the fair value adjustment? 1,000 plus what is the fair value further? Inventories. What is the carrying amount of inventory? Carrying amount of inventory is 1250 and the fair value is 1,300. So what is the fair value adjustment? 50 rupees, right? So can you please add it up and tell me what is the net assets? 6,000 plus 3050 plus 1050 is 10,100. Now what is the goodwill? Goodwill is 900. Okay. Now can you prepare console balance sheet now? So first is non-current assets. We'll write property, plant and equipment. Just come here. It's how much? 9,500 plus 7,500. 9,500 plus 7,500. The total amount 17,000. Then after PPE, what is it? Financial assets. But before writing financial assets, we'll write one more thing, that is goodwill, right? So goodwill is how much? Goodwill is 900. Very good. Now then comes what? Financial assets. Is it current asset or non-current asset? Financial asset is coming under investments. Investments, non-current assets. So I'm just writing here investments itself. Okay. What is the amount? 1050 plus 550 is 1600, right? 1600. Now further, what is this is done, this is done, goodwill is done, inventories is 1300 plus 2750, right? So because the fair value is 1300, 1300 plus 2750. Current assets, inventories. Why we are taking the fair value of X and not fair value of Y? Right, because X Limited is the acquiree, not Y Limited. Okay, so it's how much? 1300 plus 2750 is 4050. Now further, Inventory is also done. Trade receivable is how much? 5800, and cash is how much? 450 plus 400, 850, right? Trade receivable is, let me write here, trade receivable is 5800, and cash equivalent is how much? 850. Can you please total it off? 30,200. Now comes to equity and liability part. Okay. Now equity share capital. What was the equity share capital? Tell me. Which one will take? 6,000 or 7,000? Obviously. So when we prepare console balance sheet, we take the share capital of acquirer, not the acquiree, right? Who is the acquirer? Y. So what is share capital? 7,000. But understand that acquirer companies also issued new shares, right? 550 new shares, and the face value is 10. So what will write equity share capital is 7,000 plus 550 new shares multiplied by 10. Now same thing is other equity. What is the value of other equity? Tell me. 2700. So we'll write here 2700 plus 550 shares. So now what is the fair value of the Y limited? 20, right? So we have issued at 20. So 10 is face value and 10 is securities premium then, right? So it's 10. So what is the value here? Comes to 5500 plus 7000 is 12,500. Now what is this value? 5500 plus 2700 is 8200. Clear this one? Now will there be any NCI? No. Right, this is done, this is done. Now non-current liabilities is how much? 12% borrowings is 7,000. Right here. Non-current liabilities is 7,000, 12% borrowings 7,000. Further, this is also done. Now current liabilities, trade payables 2,500, right? Trade payables, current liability is trade payables is 2,500. Can you please total it off? 30,200. Is it something very difficult? No. See, the process of consolidation remains the same. Only thing which is different here is the understanding or identifying whether it is a case of reverse acquisition or not. Okay, so whole process of consolidation, that is calculation of goodwill, everything remains the same. Okay, PC minus plus NCI minus identifiable net assets, everything remains the same, but the only change is identifying which it's a case of reverse acquisition or a case of normal business combination. Okay, if it's a case of reverse acquisition, the fair value of the entity, which entity we have to take the fair value of net assets, it will change, right? So that's the only change in reverse acquisition. Rest all everything remains the same. There is no change in that. Is it clear, everyone? Now coming to the next part, that is common control business transactions. Now understand, so far whenever we did business combination transactions, what we did, we calculated the fair value of the net assets, we calculated the purchase consideration, we calculated the NCI, and then whatever the difference was goodwill or gain on bargain purchase. But now let's suppose think of it like this. Think of it like this. This is a family, okay? This or I'll say like this. Reliance has two companies, okay? Reliance has two companies. One is, let's suppose, Reliance Industries Limited, and one is Jio. Okay, let's suppose. Now Reliance has one particular asset which was owned by RIL, okay? Now what happens? Reliance transfer this company to Jio. Reliance transfer this asset to Jio. Okay. Now don't you think it's within the family, within the group itself? Will Reliance record any gain or loss? Ideally no. Why? Because I'm not recording gain or loss. Why? Because it's within the group itself. Its transfer is happening within the family itself, right? But now think of it like this. Reliance sold it to some third person. Will Reliance record a gain or loss? Yes, they will record a gain or loss, right? Now similarly, when it's about asset, now let's talk about a company. when I sell a company or when I acquire a new company, I record a gain or I record a goodwill. I record a goodwill, okay, or gain on bargain purchase. But if the purchase or the sale of a company is happening within the group itself, is there any goodwill or gain on bargain purchase required? No, not required. So what happens? It says whenever you are doing internal restructuring, okay, or common control, that is, let's suppose prior to acquisition, I was controlling the company, and after transferring that company to some other company, still I am controlling that company. Means the controlling power of that company has not changed. The parent company of that company has not changed. So in that case, you are not required to recognize goodwill or gain on bargain purchase. Definitely, you have to transfer the assets. But now, understand, you transfer the asset at its fair value, right? But now here you will not transfer the asset at fair value, but rather you will transfer the asset at its carrying amount. Okay. So now understand the difference between a normal business combination transaction and a common control transaction. See, normal business combination transaction and in a common control transaction, whenever you acquire a company, you acquire either at goodwill or gain on bargain purchase. But there is no such case here. In normal business combination, whenever you acquire the net assets of the subsidiary company, you acquire at fair value, but here you acquire at carrying amount. Okay. You are not acquiring at fair value because you are not acquiring from someone outside. You are just acquiring within the group. Okay. This is called as the internal restructuring. This is not a sort of a business acquisition. This is just the transfer of the subsidiary from one parent to another, from within the group. Okay. The controlling power, the controlling authority doesn't changes. So that's the reason. That's the reason the name itself says common control business transactions, right? Though the subsidiary changes from here and there, right? Basically, let's suppose this is a parent, this is subsidiary 1, this is subsidiary 2, this is subsidiary 3. This subsidiary 1 has again a subsidiary 4, right? Now understand that parent is controlling subsidiary 1, subsidiary 1 is controlling subsidiary 4, right? So parent also indirectly controls subsidiary 4. Now what happens? From here I remove it off, but rather I bring it here. So definitely when I transfer this when I sell from S1 to P, the internal restructuring is happening, right? Basically what happens? P acquires S4 from S1. P acquires S4 from S1, right? So can I say that it is a business combination? Understand that though it is a business combination, but not a normal business combination, because for S4, prior to acquisition, P was the parent company or the controlling company, and after acquisition, still P is the parent company or the controlling company, right? So in these cases, we say it is a common control business transaction. The control remains common before and after the date of acquisition. So we'll transfer the assets or we'll acquire the assets and the liabilities at the net assets at its carrying amount, and there is no goodwill or gain on bargain purchase. Is that clear, everyone? Great. Now it says that whenever any entity or business is being acquired or disposed of, remains under the common control of the same party. Okay, control the same party. These transactions are called as common control business transactions. Okay, the accounting treatment of it now. It says recognize the assets and liabilities of the acquiree at its book values. But now understand, whenever I'm transferring the assets or whenever I'm transferring any subsidiary or any business, or either I'm selling it off or I'm purchasing it off, definitely there will be difference in the purchase consideration that I'm paying and the assets that I'm acquiring. If I'm saying that I will not transfer the difference to goodwill or gain on bargain purchase, where will that transfer go? The question says, the standard says it will be transferred to capital reserve, irrespective of any given case. Okay, so the capital reserve can be a debit figure, can be a credit figure, but we will not record goodwill or gain on bargain purchase. We'll directly record it as capital reserve. I hope it is clear to everyone, right? And this method is called as pooling of interest method. Clear? Let's take up a question on this now. Again, this question is from your past paper. It says Enterprise Limited has two divisions, laptop and mobiles. The division laptop has been making constant profits. Okay, so it says laptop division has been making constant profits. There is no challenge in that. While division mobile is been suffering losses. Division mobile is suffering losses. Now, since it is suffering losses, I want to sell this division. Now, what happens? On 31st March 20x2, the balance sheet for the laptop division and the mobile division is given, and the total balance sheet of the company is also given. It says division mobile along with its assets and liabilities, was sold for 25 crores to Turnaround Limited. Clear? Basically, it says Enterprise Limited had two divisions, laptop and mobile. Enterprise Limited sold the mobile division to Turnaround Limited. Okay, for 25 crores. Okay, a new company who allotted 1 crore equity shares of 10 each at a premium of 15 per share to the members of the Enterprise Limited. Okay, now this 25 crore which is given by the Turnaround Limited, this 25 crore which is given by the Turnaround Limited was settled in the form of shares. Was settled in the form of shares. Okay, now understand. Shares, how many shares? 1 crore shares uh, at the rate of 25. Okay, face value is 10 and the premium is 15. Now it says Enterprise Limited, the structuring of Enterprise Limited. Understand. The structuring of Enterprise Limited is that 52% is held by a company, is held by a one member, held by a member, right? And the remaining 48% is by others. So can I say that this member controls Enterprise Limited, right? When Turnaround Limited will issue 1 crore equity shares to Enterprise Limited, so don't you think 52 lakh shares will come to this member also? Initially, mobile division was controlled by this member, right? Now, after transfer to Turnaround Limited, again 52 lakh shares out of 1 crore, 52 lakh shares of this division is again held by this member itself. So, whether before or after acquisition, mobile division was controlled by this member, right? So don't you think it's a common control transaction? It's a common control transaction, right? Now, if the question would not have mentioned this line, if the question would not have mentioned this line, this question will not be a case of common control transaction, right? So just because this line is mentioned, specified, okay, it becomes a case of common control business transaction. So you have to be very diligent in the exam. So what happens, what they do in the exam is, in the ICI study material, if you see earlier, there was a question which was not having this line. Okay, now in the exam they just included one line. The student had this question in their mind, they thought this is not a question of common control, but with this line it became a question of common control, right? So just with the inclusion of one line, the whole substance of the question changes, right? So you have to be very diligent when reading the question. Okay, so read the question properly. Now, first question is, pass journal entry in the books of Enterprise Limited. That's not a challenge, let's pass it off. So in the books of Enterprise Limited, what we are doing, we are selling of the mobile division. So let's de-recognize the assets, liabilities at its carrying amount. The difference will be transferred to capital reserve. Very good. So let's de-recognize the net assets. So entry will be, first I will de-recognize the liability. The entry is current liability account debit. Amount is 400. Then I will de-recognize accumulated depreciation account debit. The amount is 400 again. Then further loan funds is there for 300. Right now, 2, I will de-recognize the property, plant and equipment. Value is 500. Now then current assets also will de-recognize, which is 500. Now tell me, understand, Turnaround Limited gave 1 crore shares, right? But now see, what is it saying? Read this line. Who allotted 1 crore equity shares at a premium to the members of Enterprise Limited? Turnaround gave this 1 crore equity shares to Enterprise Limited or to the members? See, the question says to the members. Now understand. Let's suppose Reliance company has shares, okay, 10 shares, okay, 5 shares are owned by me and 5 shares are owned by you, okay. Let's suppose now Reliance, someone wants to acquire Reliance company, okay. What they will do, they will purchase the 5 shares from me, they will purchase 5 shares from you, right? They will pay the person who has purchased the shares will pay the consideration to you or to Reliance, to me. Is there any effect on Reliance? No. So now similarly, Turnaround Limited has given the consideration to the members and not to the Enterprise Limited, right? So Enterprise Limited will not receive any consideration for this one, okay? Now, so what happens? These are the assets or liabilities transferred. What is the differential figure? Tell me. 100. So it will be transferred to capital reserve 100. Clear? This is the journal entry in the books of Enterprise Limited. Let's pass the journal entries in the books of Turnaround Limited also, though it is not asked in the question, but let's pass it off. In the books of Turnaround Limited. Though it is not asked in the question. So what will we do? We will recognize PPE 500 minus 400 at 100. Right? Now, we will also recognize current assets at 500. 2, we will also recognize current liabilities at 400. We will also recognize this one loan funds at 300. Right? Now, plus 2. See, Turnaround Limited has paid the money, right? So definitely I'll write here vendor, how much? 25 crores, right? Now what is the differential figure? 437, 725 and 600 is capital reserve account debit is 125, right? Clear everyone, clear? Now what is the next question? Prepare the balance sheet of Enterprise Limited after entries in one and prepare the balance sheet of Turnaround Limited. Let's prepare it off, balance sheet. Just a minute. So we'll prepare the balance sheet in one, okay, one is Enterprise Limited and one is Turnaround Limited. Now first is PPE. Come here. PPE is for Enterprise, only this much, 25, 250 minus 225 is 25 only. Now for Turnaround will be how much? 100. Now after PPE what is there? Current assets. Current assets for Enterprise is only for laptop division, that is 200, and for this one it is only 500, right? Current assets is 200 and 500, right? Now any other assets? No. Clear? Any other assets or liabilities? Why it will not come? Right? Okay. Now coming to this one, loan funds. Any loan funds here? No. But loan funds is there in Turnaround Limited. How much? 300. Now further, what is there next? Equity and surplus. Okay, so loan funds will write separately. First we'll write equity and capital. Equity, capital and surplus. Now tell me, in what is the value of equity here? For Enterprise is how much? Enterprise capital is 25, right? And Turnaround is also issued equity shares worth 10 crore, 10 crores. Clear? Now surplus for Enterprise and for Turnaround. Now for Enterprise, what was the first for Enterprise? Enterprise was having 175 minus 100, right? See, the surplus didn't get transferred, right? So total was how much for enterprise? 175 minus 100, right? So it becomes how much? 175 minus 100 plus a capital reserve of 100 also was there. So I'll write here how much? Capital reserve of how 100, right? So it will become how much? 175. Now, further. Okay, now, further it becomes how much? Just a minute. For this one, turnaround, yeah. Turnaround will have how much? Tell me. Tell me, turnaround will have a equity capital of how much? Surplus of how much? Minus 125 was there, plus 20, 15 was there. 15 securities premium, right? 10 plus 15, 15 was the premium amount. So it becomes how much? It becomes how much? Tell me. 110 negative, right? So this is how it will be there. Is it clear, everyone? Now, so this is all about your, you can say, the common control business transactions. Is it clear, everyone? Now, this is current liabilities also there, right? Let's write that also. Current liabilities. What is the value of current liabilities? Current liabilities 25 and 400. Let's write 25 and 400. Can you please tally it? It comes to 225. It comes to 225. It comes to 600 and 43 plus 700. 700 minus 600. Clear, everyone? So this is how it has to be done. Now, so we have discussed so far the reverse acquisition. We discussed the common control transactions. Is it clear, everyone? Anyone having any queries? Now comes the next part, that is chain holding. Now understand the meaning of chain holding. It says basically, though whatever questions we have discussed so far, or whatever questions we will solve in the exam also or in the book also, it's like this one. Parent has a subsidiary and you are preparing the consolidation for it. But in real life, is it the case that parent will have only one subsidiary? No, right? Parent can have multiple subsidiary like this, right? So, but this one is very easy. We have to prepare the statement of net assets separately, goodwill separately, NCI separately, and just add it up. It's done. So this one is very easy to be solved. Okay. But now the challenging part is here. Parent is having investment in subsidiary 1. Subsidiary 1 has again a step down subsidiary, subsidiary 2. Means parent controls subsidiary 2 indirectly, right? So now this becomes a challenge. This becomes a challenge. How will we do the consolidation in this case? Why it becomes a challenge? Understand. The only challenge which you have to understand here is, see, parent has a subsidiary 1 and subsidiary 1 has a step down subsidiary, subsidiary 2. So parent will definitely show in its own books of account an investment in S1. Now, let's suppose parent has 60% of S1. Okay. So 40% of S1 is lies with NCI. Now let's suppose subsidiary 1 has 100% of S2. Okay. Now understand, try to understand this one. Even though S has 100% of S2, but don't you think out of this 100%, 40% is owned by NCI, right? Because for subsidiary 1, 40% ownership is with NCI. So whatever S1 has, 40% out of which is for NCI. So subsidiary 1 is recording an investment in S2, right? So I cannot say the whole investment in S2 done by S1 belongs to parent. No. A portion of the investment in S2 done by S1 belongs to NCI. That has to be adjustment, and that is the only adjustment which is required in chain holding. No other adjustment. The rest all remains the same. See, understand, first and foremost point, as I told yesterday, the answer for control can be yes or no, but the answer for ownership can be different based upon the percentages. So now when I talk about the control, yes, parent controls subsidiary 1 controls subsidiary 2, and parent controls subsidiary 2 indirectly. Okay, so parent controls subsidiary 1 also, subsidiary 2 also. So when it comes to control, yes, parent does control. Now, but what when it comes to ownership? When it comes to ownership, let's take up an example. P owns 60% of S1 and S1 owns 80% of S2. Okay. So now when it comes to control, as we told that P controls S1 and P controls S2 both, right? But when it comes to ownership, see, it will be P has an ownership of 60% in S1, but P will have an ownership of 60% of 80% of S2. That is 48% of right. Now once it becomes 48%, he will say, sir, I don't have the controlling power, right? No, I have controlling power. I do have controlling power. Okay, though indirectly, but I do have controlling power. See, understand, how do I have controlling power? P controls S1, right? So whatever P wants S1 to do, S1 will do, right? Now S1 controls S2, right? So whatever S1 wants S2 to do, it will get done. So definitely SP can govern S1 to direct S2, right? So indirectly P controls S2 also, but the ownership is different here. Ownership. So when it comes to ownership, P has an ownership of only 48% of S2 and NCI has an ownership of 50% of S2. Is that clear? So ownership ratios can be different. It can be different. So don't worry. Just because of ownership percentage is more than 50%, don't understand that it is a case of that we have lost the control. No, we have not lost the control. Okay. Now, what you have to do here? We have to use these ratios for allocating the net assets to parent and NCI. Okay. When we are calculating goodwill, how do we calculate goodwill? Investment plus NCI minus net assets, right? That's what we are doing. Investment. Now there are two investments. One by P in S1, another by S1 in S2, right? So there are two investments added. Now we will remove less investment in S2 done by S1, which is held by NCI. Understanding this point? Because there will be investment. See, in S2, who has done the investment? S1. Do I control 100%? Do I have the ownership of 100% of S1? No, 60% only. So 40% of the investment done by S1 in S2 is not belonging to me. So I have to remove that from here. Okay. Now again, I will add NCI fully, adjust NCI net assets fully, and the amount which comes will be goodwill. Now, if I am doing the adjustment here, there will be a corresponding second leg of the adjustment also, which is again done in NCI. Okay, done? Clear here till here? So this is how we have to prepare. Now this is the, I'll say this is the only, only adjustment extra in chain holding. This is the only adjustment extra in chain holding. Clear? Can we solve the question now? Let's try to solve the question. This is again July 21 question number 1A. If you have noticed, always question number 1A comes from consolidation or business combination, right? So we cannot take chance in question number 1A, right? So let's try to solve it off. So what does it say? Given below are the balance of a group of companies comprising LX, MX and NX Limited as on 31st March 2021. Okay. Now, see here. LX, MX is the MX is the subsidiary of LX and NX is the subsidiary of MX, right? So you can now what further it says it says LX hold 85% shares of MX and MX holds 60% shares of NX, right? Now further the date of acquisition is also important. So it says this was acquired on 1st April 2020 and this was acquired on 30th September 2020 and we have to prepare our balance sheet on 31st March 2021, meaning thereby this was acquired during the year. Okay. Now the reserves and retained earnings is given, right? Dividend is not given here. There is no concept of dividend here. It says accounting policies to measure the NCI at fair value applying Ind AS 103. Fair value is given, basically the market price is given, so we have to multiply the number of shares with the market price and we'll get the NCI. we have to prepare the console balance sheet on 31st March 2021 is the question. Question is very easy, no particular adjustments, but rather just I want to discuss the concept of chain holding. Okay, that's why I've taken a question which doesn't have any further adjustments to make you to confuse you. Okay, so just to easy, a simple easy question, a simple and easy question. Now understand. First and foremost point, step 1, always remember this one. First we'll assess how much percent is my control and how much percent is my ownership. So always control is, so you can write here LX, always control MX and NX directly and indirectly through MX. So control is there. Now step 2 is ownership. LX and MX, 85% ownership is there and NCI is 15%. Now MX, sorry, no, not MX, LX and NX, how much is there? 85 and this person holds 60%. So it is 85 into 0.6 is 51. So 51% is the ownership here and 49% is the NCI here. Clear till here? Now step 3 is prepare a statement of net assets for MX. So what we write? Date of acquisition, post and reporting date. What is the share capital? What is the other reserves and what is retained earnings? Can you please help me with that? See, on the date of acquisition, share capital will remain the same, assuming there are no subsequent issue of shares. It's 2000, right? 2810 and 600. Reporting dates 2810 and 600. 810 and 600 is other reserves and retained earnings. Okay, fine. And reserves and retained earnings on the date of acquisition, on the 1st April 2020. For MX, what is the date of acquisition? 1st April 2020, right? So this is on the date of acquisition, 760 and 480. 760 and 480. Assuming there is no subsequent issue of shares, so it remains 2000 itself. There is no change, right? So what is the change here? 760 and 80, 50, 40, 50. And here it is 120. So it becomes how much? 2000 plus 760 plus 480 is 3240, which will be helpful in calculating goodwill. Now this becomes 170 and this becomes how much? 2000 plus 810 plus 600, 3410. Now what will we do? We'll say what is the amount for LX and what is for NCI. LX owns how much for MX? 85% and NCI is 15%. So 170 into 85% is 144.5 and NCI is minus 170 is 25.5. Clear till here? Similarly, can you do it for NX also? Please, all of you do it off. NX. Statement net asset for NX. Date of acquisition, post acquisition and reporting date. So share capital, reserves and retained earnings. So what is the share capital? 1600, 580 and 310. Pardon? 1600, 580 and 310. Now assuming there is no issue of shares, it is 1600 here. But now understand, this is 30th September. But it says the balance of reserves and retained earnings is given on 1st of April as 520 and 150. So let's write first. Let's write 520 and 150. 520 and 150. Okay. But this is on 1st of April. So can you please tell me what is the difference during the year? 520 plus 150 minus 580 minus 310 is 220. Means 220 is a profit earned during the year. Now read this line. Business activities are not seasonal in nature, means the profit will be distributed evenly, right? So half year means what we'll do is pre-acquisition profits I will write here 220 by 2, that is 110, right? So now can you please tell me what is the post-acquisition profits? It will be 110 only, no? Right? Half pre, half post. Now, so what is the total here? Can you please tell me? 1600 plus 520 plus 150. Pardon? I didn't get your point. I didn't get your point. So it says the total profit from 1st April to year end is 220, right? But our date of acquisition is 30th September. So half of the profit is pre-acquisition profits. Okay, so that's why we are adding in the post date of, the date of acquisition. So it becomes 2380 and 110, right? So now again LX and NCI. What is the ownership of LX now? 51% and 49%. So tell me what is the value here? 110 into 0.51 is 56.1 and minus 53.9. Clear? Now can we calculate goodwill now? This one was step number 4. Let's step number 5. Now let's calculate NCI first. Okay. How many shares? Tell me. How many shares? Total number of shares of MX is how much? 2000. Right? 15% is not held by parent, right? LX, that is 15% is NCI. So 2000 multiplied by 15% is NCI, right? Multiplied by what is the fair value per share? Tell me. What is the fair value per share of MX? 120. 2000 divided by 100. 100 shares into 120, right? Can you please tell me what is the amount? 15%. So 2000 divided by 100 into 0.15 into 120 is 360. Is 360. Now LX and NX. So what is total number of shares? 1600. Divided by 100. Now what is the amount held by NCI? 49%. What is the fair value of NCI? Sorry, fair value of this one, NX Limited? 125 per share. Into 125 per share. So what is happening? 1600 divided by 100 into 0.49 into 125 is 980. Clear? Now less. I'm just leaving it blank and moving ahead. Okay, you also leave it blank. You can leave 3 lines, okay, and move ahead if you're solving in your book or wherever you're solving. Step number 5, it will be not 4. Now let's calculate goodwill. Okay, now investments. Now LX has invested in MX how much? What is the amount? See, 2620. Now MX has invested in NX 1350. Now understand, less investment in NX, done by MX but held by NCI. Understand? See here, MX has invested in NX, right? The balance is 1350, and LX owns 85% of MX, means 15% of MX is owned by NCI. So 15% of 1350 is also owned by NCI, so which is not owned by us. So I'll remove that as well. So I will remove 15% of 1350, which comes to how much? 202.50. Is it clear, everyone, till here? Now this is the total value of investments. Can you please add it up? 3767.50. Very good. Now comes to NCI. We calculate 360 and 980. Okay, so just write here 360 plus 980. Tell me what is the figure? 360 plus 980 is 1340. Less net assets of MX and for NX. What is the net assets of MX? 3240 and 2380. 3240 and 2380. So what is the goodwill and gain and bargain purchase? So it's 3767.5 plus 1340 minus 3240 minus 2380. It's 512.5 gain on bargain purchase. Clear, everyone? Clear? Is it clear? Now let's come here, NCI. Let's complete NCI. Now NCI also we have to do again the same adjustment. Investments in NX held by NCI. Exactly same amount. 202.5. Now further what we'll do, we'll add post acquisition profits of MX and NX. What is the amount? Can you please tell me? 25.5 and 53.9. 25.5 and 53.9. Can you please add it up and total and tell me? 360 plus 980 minus 202.5 plus 25.5 plus 53.9. Is it clear? 1216.9. Is it clear, the logic and the concept? So we have calculated NCI, we have calculated goodwill. Now only thing which is remains to be calculated is console reserves. Step number 7. Console reserves on the 31st March 2021. Now let's calculate that as well. What is the parents console reserves? Parents reserves and retained earnings, tell me. So let's calculate in one only, reserves and retained earnings. Reserves is how much? Parent is this two, right? It is 1150 plus 1030 is 2180. Clear till here? It is 2180 plus we will add what? Post acquisition profits of MX and for NX. Can you please tell me? It is 144.5 and this one was how much? 56.1, right? Any other adjustments? Yes, gain on bargain purchase 512.5. Any other thing that will come here? Tell me, guys. No. Let's total it up. So it comes 2180 plus 144.5 plus 56.1 plus 512.5 is 2893.10. Now tell me, can you prepare the balance sheet now? So we have prepared calculate console reserves on 31st March 2021, right? We know the value of NCI on goodwill or gain on bargain purchase. We know the value of this one NCI on 31st March 2021, right? We know everything. Now we do have the balances also. It's just we have to prepare the console balance sheet. Let's prepare it off. So for PP, any fair value adjustment to be done? No, right? So what we'll do, 1500 plus 1600 plus 1400 is 4500 PPE. Any goodwill? No. Investments will get knocked off. Now inventories, 1230 plus 1230 plus 730 plus 1180 is 3140. Clear? Now then trade receivables, 1415 plus 270 plus 620 is 2305. Now bills receivable is 650 plus 60 710. Then comes cash in bank is 1085 plus 90 plus 150 is 1325. Coming to equity capital will be 3400, right? Then retained earnings will be 2893 retained earnings plus other reserves as a cumulative figure 2893.1. NCI will be 1216.90. Now other current, this one is trade payable is how much? 2920 plus 690 plus 805 is how much? 4415. 4415 is this one. Now bills payable MX is 55. So okay, we have to adjust 55 here. 710 minus 55 is 655. Now can you please add it up and tell me, is it clear, everyone? What is the total? Is it matching? No difference, right? Matching, right? Is it clear, everyone? The chain holding. So only thing that you have to take care is calculate ownership percentage. Again, eliminate the investments and NCI. Eliminate the investments and NCI for the amount of investments or the value of investments which is not held by the parent, that is which is held by NCI. Okay. So this is the only concept for the chain holding. Is it clear, everyone? Anyone having any queries in this one? Come on, guys. Yes, please. Sure. I'll just go there. This one NCI. So now we'll be discussing about certain theory topics. Okay, not anything major, but yes, let's discuss it up and wrap it up. Now, see, we were discussing about business combination, right? So we need to understand what is the meaning of business combination, right? So business combination is any transaction where an acquirer obtains the control over the business of another company. Now there are two things which are important. See, understand, acquiring a company which obtains the control. Okay, control over what? The business. The two things which become important here is control and business. So we need to understand whether there is a business or not. If there is a business, we have to have the control over it or not. So if there is a business and we have acquired the control, that is a business combination. So in this class now, going forward, now we have to study only two things: the meaning of business and the meaning of control. Okay, now business. Standard says that business is an integrated set of assets or activities having following three elements, that is inputs, processes and outputs. Inputs, processes and outputs, right? Inputs are basically any assets or resources on which the processes are applied and outputs are generated, right? So assets or resources required to generate output or has the capability of generating outputs. Now what is the meaning of capability of generating outputs? Now there can be a startup. In the case of a startup, they do have an idea, right? For you can say executing their idea, they do purchase the assets. But when they purchase the assets and when they have an idea, there is an input, there is a process, but they don't have the output as of now because they don't have any revenue as of now, right? But that doesn't mean that if they are not having any revenue, that is not a business. That is a business, provided we can say that even if they doesn't have the output as of now, but they have, you can say, capability to generate the output in the future. Okay, so there can be an output, there cannot be an output. But if there is no output, we should see that there is an ability or a capability to generate output or not. Okay, now, so rather we can say business as a set of inputs plus processes, processes plus output can be there, or inputs plus processes plus no output but capability of generating outputs. So output is not mandatory to exist. Okay, understand? Now, so it says processes are the systems or the conventions applied to generate the outputs. Now outputs are ability to generate revenue. These are the three things. If anything that we have acquired that has all the three things, it means it is a business. Inputs, processes and outputs. Even if there is no output but it has the capability of generating outputs, that is again a business. Now understand, these processes are applied on the inputs to generate outputs. Okay, now control. But before going to the control, I want to discuss one more thing: the business acquisition versus asset acquisition. See, though we understand that the standard gives us the meaning of the business, but when a company has acquired another company, how will we assess that it is a business acquisition or not? So for that, the standard gives us properly two tests to be done. One is concentration test and one is substantive process test. Concentration test and substantive process test. Now, understand, let me explain you this with the help of an example. Let's suppose what happens is when we fall sick, okay, so what happens, just our parents just sees our hand and just sees if our body is warm or not, and accordingly they says that if it is not warm, it's like we don't have the fever, okay, or we do have the fever. But is that a conclusive test? No, right? So if they can touch our hand and assess, yes, you do have fever, they can say yes, you do have fever, right? But they cannot say that you don't have fever. Okay, now that's what is concentration test. It's an optional test. Okay, which if we do, definitely we can assess there is an asset acquisition or not. But we cannot say that this is a case of business acquisition or not. We cannot say that. Okay, if the concentration test gets passed, we can say it is a case of asset acquisition. But if it fails, we cannot say that it is not a case of asset acquisition or if it is a case of business acquisition. Okay, So just because concentration test has failed, we cannot say it is not a case of business acquisition. Okay. So what we have to do? What we have to do? If the concentration test passes, yes, asset acquisition. But if it fails, rather than saying it is a case of business acquisition, no, I will not say that, but I will move on to substantive process test. Now here, if substantive process test passes, yes, it is a case of business acquisition. If substantive process test fails, it is a case of asset acquisition. So now what happens? Substantive process test is a conclusive test. Basically, it's like we have visited a doctor, right? It's a conclusive test. Whatever the doctor says is conclusive, but whatever we just assess from our experiences is not conclusive. Okay, so that's what. So now we do have again two options. We can go to concentration test. If it pass, asset acquisition. If it fails, then substantive process test. If substantive process test pass, business acquisition. If substantive process test fails, then asset acquisition. Second option, we will not do concentration test. Directly we'll go to substantive process test. Okay, like for example, if I was not feeling well, first option is I will just see whether I do have fever or not, or assess. Second option is I will not do all these things. I will just book a doctor appointment. I'll directly go to the doctor. Right? Similar thing happening here. So first is I do have an option to take concentration test, or I do have an option directly to go to substantive process test. So it says the substantive concentration test is an optional test. Okay, not mandatory to be done. But to assess whether it is a business acquisition or an asset acquisition, substantive process test is mandatory and a conclusive test. Clear, everyone? Now comes the question. Definitely we understood the overall skeleton of it, but we need to understand what is the meaning of concentration test and what is the meaning of substantive process test. Now understand. Concentration test. It says it's an optional, as I said, it's an optional test. It says when you are to do concentration test, first and foremost, calculate the fair value of the gross assets that you have acquired. Okay, what are the assets, total assets that you have acquired, gross assets, fair value. Okay, which you have to calculate using the fair value of the consideration that transferred, whatever you have transferred, plus fair value of the previously acquired interest if you had any. Okay, plus fair value of NCI, plus fair value of the liabilities assumed, minus cash and cash equivalents. Clear? So this will give you the fair value of the gross assets acquired. Okay, now basically this is what you have paid to acquire the total entity. Do not include deferred tax assets or deferred tax liabilities because they are not actual assets or liabilities. Second, identify single identifiable asset or a single group of identifiable assets. Okay, might be, let's suppose you have acquired total assets worth 1000 crores. Okay, now you have paid basically 1000 crores to acquire the total entity, basic total overall. In that, the single identifiable asset is, let's suppose, 950 crores. Meaning thereby your intent was to purchase this asset costing at 950 crores rather than to purchase this 1000 crores of the entity. I'll take you an example. Okay, let's suppose Tata wants to acquire X Limited. The balance sheet of X Limited is like this: share capital 950, okay, and land 950. Okay, now Tata paid to X Limited how much? 1000 crores. Now tell me, in this case, is there an input? Yes, land is there, but any process is there? No. Any output is there? No. So what happens? Though it is a case when the Tata is acquiring X Limited, but still it is not a business acquisition, it is an asset acquisition formed by way of entity. Okay, it's just the entity owns an asset and we are acquiring an entity. So though we are acquiring an entity here, but it is a case of asset acquisition rather than a business acquisition. Is that clear, everyone? So that's what it says, that the whole of the amount that we have paid, is concentrated on a particular asset, and that's the reason why it is called as concentration test. And if it pass, it becomes a asset acquisition. Okay, now it says if it forms 90% or more. Okay, if it is 90% or more, it is a case of asset acquisition. Clear everyone? Now comes substantive process test. Though we studied that in any business there should be a input, a process and a output. Now substantive process test says that the input is mandatory. Input is mandatory. Just read this paragraph. What it says. As discussed earlier, that a business has three elements: inputs, processes and output. Where outputs are not mandatory, okay, fine, and hence an integrated set of assets or activities must include input. That is, input is mandatory to have. Okay, now, and a substantive process. Now, what is the meaning of substantive process? Understand? So it says there can be two possible options. Understand? Option number one, definitely you should have inputs. Definitely you should have inputs, and you should have process. You should have process and you should have output. If all the thing is there, it is a business. It is a business, right? Now read this paragraph. It says if set of assets does not have any output at the acquisition date, meaning thereby I do have input, my process is there, but I don't have any outputs. I don't have any outputs. It says process is very critical. Okay, process is very critical, and critical means what? The process has that ability. The process has that ability which, when applied to the inputs, will generate revenue in the future. Though it is not having any output today, but it will have output in the future. So that's what it says. Plus the inputs should have a skilled workforce. Now understand what is the meaning of skilled workforce. Now let's suppose the inputs in which I am having, okay, is just a bare land, or the employees which are there are just a normal persons, okay, admin persons. They are not skilled employees, okay, they are just a normal persons. Now tell me, if I want to acquire a company, normal persons can be replaced, but what makes the entity different is the skilled workforce, right? What makes the entity different is the skilled workforce. Now, so that's the reason why it says that skilled workforce should be there, and any other inputs required by the skilled workforce. Okay. Now further, if the set of assets has outputs, okay, I am writing here or. Either the situation can be there, or, meaning thereby I do have inputs, I do have process, I do have outputs as well. Now, just because I have all the three things, I cannot say it is a business. Now again I have to assess. Now the process should be critical. Now see, understand, when I didn't have the output, I said the process should be critical to has the ability to generate output in the future, right? Now the process should be critical, the ability to continue producing outputs. No, there is an output today, but the process should be substantive and critical, means the process should have the ability to continue producing outputs. See, even if I have the output today, okay, fine, but I should see that this has an ability to continue producing outputs in the future or not. If I have the outputs today, fine, might be future I don't have, I will not have the outputs, right? So it says, though I do have the outputs today, but I should have the output in the future as well, right? So there should be a capability to continue producing outputs, and there should be either skilled workforce, or, see, understand, when the entity already has the output, it says the process should be unique. Or scarce, which cannot be developed by the acquirer if developed which requires significant efforts of the cost of the acquirer. Now understand, let's suppose two entities in the same line of business, okay, one entity wants to acquire another company, okay, definitely the process which this company is having, the acquired company will also have the same process, right? So if I'm acquiring that company which is having inputs, process and outputs, what additional benefit I'm getting? See, definitely the company which I'm acquiring is having input, is having processes, is having outputs, but those processes I also have, right? So this process is not something substantive. So it says the process should be something which is different from what I am already having, unique, or the process should be something which the acquirer cannot make, okay? Either it will require significant efforts or significant cost. That's the reason acquirer cannot make. So when this process is acquired by the acquirer, it will make some difference, right? Hence, this is called as a substantive process. Process is there, but that process should be substantive. That's the meaning. That's the meaning. Okay. So now, if either of these is there, we can say it is a business acquisition. If none of them get satisfied, it is a case of asset acquisition. It is a case of asset acquisition. Now, though asset acquisition is not covered under Ind AS 103, but still Ind AS 103 gives the guidance on the accounting treatment. Understand? Let's suppose there is a group of assets A, B, C. The fair value is 10, 15, 20. Okay, total is 25, 45, right? But I paid 50. Purchase consideration is 50, right? So ideally, if it is a business acquisition, what will I do? Purchase consideration is 50, net assets is 45. I will record a goodwill of 5. But if it is a case of asset acquisition, I will not record goodwill. Rather, I will record this 50 to A, B, and C in the ratio of 10, 15, 20. I will allocate 50 to A, B, and C in the ratio of 10, 15, 20. That's what is written here. See, identifiable assets acquired and liabilities assumed. The cost of the group of assets will be allocated to individual assets or liabilities on the basis of their relative fair values on the date of purchase. No goodwill or gain on bargain purchase. Clear, everyone? That's a case we will assess and identify whether it is a case of business acquisition or not. Now coming back to the business acquisition. Business combination means when an acquirer obtain control over the business. Now we know what is the meaning of business. Okay. Now we need to understand what is the meaning of control. Assuming there is a business, we have got the control or not. So what is the meaning of control now? See, Ind AS 110 gives 3 conditions for control, and it says all of them needs to be satisfied. All of them needs to be satisfied. The conditions are: there should be a power over investee, there should be a right or exposure to variable returns, and there should be an ability to exercise its power to affect returns. Meaning thereby, I do have the power over the company to take decisions, to take relevant decisions. Okay. Now, further, when I have the power, I do have also exposure to variable returns. Okay. Now, third, I also have the ability to exercise my power to affect the returns which I am getting. Okay. Now, before we discuss anything, let's take up an example. All of us know Sundar Pichai. Who is he? CEO of Google. Okay. Now, is he the founder? No, he is not the founder, right? Google. CEO is Sundar Pichai. Okay. Now, definitely Sundar Pichai will take all the operating or financial decisions of Google. Being a CEO, he has a right to take all the operating decisions. So definitely I can say he has the power over investee. First condition satisfied. Second condition, he will definitely have the shares of Google also. So whatever decisions he will take, his returns will also vary according to that. So he has the exposure to variable returns, right? Third one, ability to exercise its power to affect returns. Now let's suppose Sundar Pichai wants to take any decision, okay, any particular date, which the founders of Google didn't approve. Okay, don't you think they will remove Sundar Pichai? Right? So understand, if Sundar Pichai wants to take any decision which the founders of the Google didn't approve or didn't want to happen, or let's suppose Sundar Pichai has taken the decision, don't think they will remove Sundar Pichai from the position then in that time itself, right? So does Sundar Pichai has the ability to affect its power to affect the returns? No. Sundar Pichai does not have the ability to exercise its power to affect the returns. So third condition doesn't satisfy. Why? Because the Sundar Pichai is the agent of the founders. He is not the founder, right? So thereby Sundar Pichai does not control Google. Understood? Okay. Now let's come to here again. power over investee, exposure or right of exposure to variable returns, and ability to exercise its power to affect the returns. That is principal versus agent. Now coming to power over investee. Power over investee can come in two forms. Over investee can come in two forms, either through contractual rights or through voting rights. Okay. Now contractual rights means I have the ability to direct the relevant activities. Okay. Now definitely Sundar Pichai had the ability to direct the relevant activities through its might be through its voting hour power or might be through contractual rights. Okay. So now let's suppose if there is one particular relevant activity, okay, that is the operating decisions. Now we'll see who has the power to take operating decisions. Okay, and that person has the power over the investee. But if understand, if there are multiple relevant activities, and different persons has the right to take different decisions, then who will have power over investee? Then in that case we will see which relevant activities has most significantly affect returns, which relevant activity most significantly affect the returns, and the person who has that right will be called power over investee. Now if we go through voting rights, we'll see who has the majority voting right, that is voting right more than 50%. The person who has more than 50% has the power over investee. Now minority voting rights, meaning thereby if my voting right is less than 50%, it is still I can have control. How? Understand, let's suppose Reliance, just assume Mukesh Ambani owns 20% of Reliance. Okay, is it a majority or minority? Minority. The remaining 80% is owned by, assume, a general public. Okay, now tell me, these general public can be crores of investors. Are they linked? No. Are they related? Are they active? Now I also purchase equity shares of Reliance. I get multiple times, whenever the AGM happens, I get the mail to vote. But have I ever voted? Not even once. Right? So we are not active also. So what happens, even though Mukesh Ambani has only 20% voting right, but still the remaining at 80% are not connected, they are widespread, they are not active, right? And hence this becomes substantive. Okay, so it says though we do have a voting right which is minority, but the other majority shareholders are widespread, not connected, not actively participating. Now Mukesh Ambani has how much? 20%. Now other investors will have how much? Either someone will have 0 point something percent, right? Even if I will have 1000 shares or 2000 shares, it will be some 0.000%, right? So now compare 20% with this one. So no individual person have absolute power. So now if you see absolute size of holding of Mukesh Ambani versus relative size of others, right? The relative size of others is very small. So again, though Mukesh Ambani is having 20%, which is minority, but still that 20% is substantive. Is it clear, everyone? So that gives him the power over investee. Now we understood the power over investee. Coming to exposure or right to variable returns. Basically, whenever I have the power over investee, okay, whenever I have a right, I should get affected with that right also, right? If my decisions are correct, I should get remunerated for that. If my decisions are wrong, I should get basically I should pay the penalty for that, right? So that's what rights or exposure to variable returns. Third one is ability, meaning that by principal versus agent. If I am the principal, I do have ability. If I am not the principal, if I am an agent, I don't have the ability, right? If all the three conditions get satisfied, I can say the control exists. Otherwise, the control doesn't exist. Is that clear, everyone? So that's the meaning of control. So now we have discussed chapters revenue, leases, share-based payments, financial instruments, business combination, and consolidation, right? Which covers on an average around 60 marks from an exam perspective, guys. Okay, so what you have to do is you have to watch these lectures properly. If you have not done it, okay, these lectures will be uploaded on YouTube as well. Okay, from 20th we'll start uploading it off. Still, if you have any queries, you can reach out to me on this number, WhatsApp me on this number. Okay. Now, you can also subscribe to my YouTube channel, which is CA Vishal Jain. If you have not done it, all the lectures plus amazing contents on financial reporting will also be uploaded there. Also, I'll be posting certain revisionary videos on other standards like EPS and employee benefits in the times to come. Okay, so that's all for the day, and that's an end of our FR marathon. Okay, thank you guys.